Hey guys, welcome back. In today's video, we are talking about the disappearing FTDs, Citadel covering the bad swaps, and many more in this video. First, we take a look at this. So FTDs fails to deliver have become a massive problem that threatens national security and the global financial system. This is the practice where they sell securities they don't own and can't deliver or settled. This creates synthetic shares way above the legally issued float, and this is facilitated by the DTCC. Now, the important thing about this is essentially they don't settle the trades but take payment and don't deliver, leaving many retail investors with IOUs. And so all of the companies that have huge short interest encounter fails that are compounding, driving the company market cap and shareholder value down because it artificially dilutes the company. And so I want to bring you back to this previous picture we've seen. As you can see, this is for 2023, but it highlights the hidden problem that exists for AMC, where people may not focus on it today, but we all know that's a problem that exists, and is why we're seeing the regulations really trying to take control over the last few days. So you can obviously see here, firstly, we're seeing the immense amount of FTDs that exist for AMC. You guys can see it was in the millions, ranging anywhere from 32 all the way up to 50 just in these few days. Now, what's important, it's about understanding that suddenly it went down from 50 million to 11,000. Now, we know that this isn't normal. We've talked about what they've done in the past when you see things like this, in terms of what they have done. And that's why we've said, in terms of all these value that they've hidden, all these FTDs, it exposes a big problem. And now it's more on today's time about why these problems are, of course, massive. Firstly, let's understand the participant fund. So this one's a big deal because it shows why Citadel would cover the asses of Melvin Capital. So each DTCC participant has to deposit into the participant fund. Now, the big bone being what they term the loss allocation waterfall. And it works like this. First, the DTCC would dig in, for example, Citadel's collaterals at the DTCC to cover any losses. If they can recover the loss from the collateral, the DTCC tries using its own reserve fund to cover the losses. And so if losses are still present, the DTCC starts digging into other participants' deposit to cover the losses. And so system-wide margin calls to all participants, asking all institutions to put up collaterals. This is why every institution is trying to cover each other to make sure the DTCC does not fail. And this is how the end game would play out. All institutions being margin called if the DTCC failed to collect from a defaulting institution. And so this explains multiple things, and this also explains everything that we have been discussing recently. Now, firstly, we've already highlighted in terms of the problems that's being shown with the millions of FTDs that exist for AMC. But then it's about understanding what else is happening, and it's about understanding why every time when you're seeing these firms fail, how they magically get revived, how they magically see another injection of liquidity coming in. And we've talked about this. It's because they are being protected by other firms. Whilst it may not be something that they choose to do, it's something that's obviously in these agreements. And so that's what we have to fight for. We are not just fighting against one or two. We're obviously fighting against a big chain of institutions that obviously exist out there. And we are already seeing how it's starting to crumble down. But to really highlight in terms of why this has been so difficult, it's because it's not just one firm that's involved in this. It may be, 3 or 4 firms shorting AMC, but because of how the system is made, because of everything that's been discussed in the past, we can see why it all links in together. But that's also understanding then why when we do get the margin called, it would be system wide and it would, blow up multiple different firms. And you can also see this. So we've talked about the FTD problems. We talked about the system wide margin calls. And now we're also seeing the swaps. And now we explained briefly about what they have done. Essentially, we can see how they've withdrawn the advisory pertaining the registration of the swap execution facilities. And so what it's saying is that what changed? Maybe they realized someone's been playing fast and loose with the rules, and now the house of cards is wobbling. Wall Street's dark magic is coming to light. First, UBS is selling off assets, then FINRA is on the ropes, and now the CFTC is backing away from its own rules. This isn't just a coincidence, it's checkmate in slow motion. So we talked about this where essentially they don't right now see what sort of swaps should be regulated and what sort of swaps shouldn't be regulated. Now, there is a very reasonable explanation for this. Firstly, when you take a look at this, you can see UBS auditor issues warning on the bank's financial reporting controls for 2024. And you can see Bigham's reply with, they get Credit Suisse bad bets today and they're issuing auditing problems the next day. Remember when we F'd them so hard they had to lock the files away for 50 years. So one of the things that we know is that whilst the files has been locked away for 50 years that the public can't get to see, so we don't understand what exactly happened, we've always had obviously our data showing that the toxic swaps they had of AMC, of GME, and of course others as well, ultimately led to the demise. And that's also what happened with Archegos, because that's originally got, what got Archegos to be bankrupt to then be inherited by Credit Suisse, who then bankrupted Credit Suisse. So we know that's happening. And again, the highlight is on swaps right now. So UBS had to inherit all of Credit Suisse's positions, whether it's good or bad. And in this case, it's very, very likely that they mostly are bad. Now, what's included in those are obviously the swaps positions. And then we're going back to this in terms about the 180 on the swap execution facilities, where you no longer have to register to trade swaps. And so you can see that these things are starting to link up together. One day we see that they get the swaps, the UBS gets the swaps from Credit Suisse. We're seeing them having financial reporting problems. We're seeing how the CTFC is retracting, what they once originally did to regulate the swaps. And everything is obviously very, very clear. And that's what we talked about in terms of understanding is checkmate in slow motion. And you can also see just in the DTCC is changing the rules of what constitutes a market disruption. The new framework allows them to anticipate when a disruption may come and to take preventive action. For example, shutting off the buy button when stocks that their pals at Citadel have massive short positions against begin to squeeze. And so this is just another power grab that allows the DTCC to do whatever they want at the expense of the retail investors. And again, you can see another thing that is done to obviously prevent the squeeze, to prevent from the market from having a massive collapse because of the bad decisions that these people have made. Firstly, we talked about the FTDs, who are regulated and facilitated by the DTCC. Then we talked about the fund, the collateral fund, the loss allocation waterfall at the DTCC. And now what we're seeing is how the DTCC changing rules of what constitutes a market disruptions to obviously make it so that it's working towards their way. And so if this isn't clear enough already, then I don't know what is. We've just talked about every action they just took in terms of trying to protect themselves. And what this means is that they obviously see something happening. So they're taking, the initial steps to try to, whether it's to prevent it or whether it's to try and protect themselves when that certain thing happens. Now, we all know that right now in this current market, there are many things to be happening, whether it's the commercial real estate collapse, or whether it's the illiquidity issue. But one of the biggest things is, of course, the MOAS, the squeeze of AMC and GME, because they've created hundreds of millions, billions, if not trillions of shares of AMC and GME that exist out there. And so when those obviously squeeze, it would cause a massive, massive collapse. And that seemingly look like what they're trying to prevent right now. And one thing I want to say is that as to say that they are trying to prevent themselves, I'm more towards the side is that they know they can't prevent it anymore, but they want to take things to try and minimize the loss or to try and protect them. But again, I don't think that's going to work out when you consider everything that has obviously happened. And you can also see here, the Fed money printer isn't printing quite as fast anymore, thanks to POTUS and Doge, and the Fed continue to reduce its balance sheet, so financial markets are entering new territory. So this is obviously talking about the illiquidity issue. Now, this isn't just about, one particular factor. Like I've said, there are multiple factors showing why the illiquidity issues is becoming more and more concerning. And again, that's down to multiple different factors, not just the one we've just highlighted now. And what that means is, of course, that as we see that there are less money flowing around, as we see that firms are struggling, what we are also going to be seeing along with that is the fire sale of assets. And that's exactly what's going to happen. And that's going to cause all of these firms to obviously crash. But yeah, guys, thanks for watching this video. I'll catch you guys next time.